Welcome back to Investing Talk Podcast.
Today we're looking at a fascinating company at the center of the critical mineral space.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
We're looking at a company that's making a really significant pivot, right? Moving from being just a U.S. uranium producer to something much broader.
Exactly. They are repositioning themselves as a diversified critical minerals platform. So think uranium, yes, but also rare earth elements and heavy mineral sands. It's a huge strategic shift.
And for a shift that ambitious, you need a serious competitive edge. What's their moat here? What stops someone else from doing the same thing?
It all centers on one, frankly, almost irreplaceable asset, the White Mesa Mill.
Okay. And what makes this mill so special?
Well, it's the only conventional uranium mill that's currently operating in the entire United States.
The only one.
The only one. Just think about the regulatory hurdles, the permitting, the sheer capital it would take to build a new one today. It gives them this massive infrastructural and regulatory advantage that's just incredibly difficult to replicate.
So it's not just an asset, it's a strategic bottleneck that they control.
That's a great way to put it. And they're leveraging that bottleneck. They're using this unique permitted facility to process not just uranium, but now rare earth elements as well.
And what's the scale of this vision? I mean, financially, what are they aiming for?
The numbers are pretty staggering. Management's goal is for the critical minerals side, so the rare earths and mineral sands, to eventually generate up to nearly $1 billion in annual revenue.
$1 billion?
Specifically, they've guided for up to $986 million. You compare that to their current sales, and it's not just growth, it's a transformation, orders of magnitude higher.
That really puts the ambition into perspective. But a pivot like that needs fuel. What's the cash engine powering this whole thing? I assume we have to look at the uranium business for that.
We do, and that market has been, incredibly favorable for them. It provides the financial ballast they need for these huge investments.
Let's talk specifics. Where are uranium prices right now?
Well, the U3O8 spot price was sitting at about $82.50 per pound as of late October. Long-term contracts are even a little higher, around $86.
$86. And how does that stack up against their internal costs? Because that's where the margin is.
Right, and this is where it gets really compelling. Their weighted average cost for finished uranium is tracking at around $53 per pound.
$53. So against an $80 plus market price. That is a recipe for some serious gross margin.
Huge margin expansion potential, especially as they scale production into 2026. In fact, management is already suggesting they're on track to beat their 2025 production guidance.
So the legacy business isn't just surviving, it's thriving and funding the moonshot.
Precisely. The high margins there really help de-risk these early-stage, more complex investments into rare earths.
Okay, let's talk about that moonshot then. The rare earth breakthrough has been the main catalyst getting investors excited recently. What exactly did they achieve?
This was the big one. They successfully completed pilot production of high-purity dysprosium oxide. And when I say high purity, I mean they hit a remarkable 99.9% purity level.
Dysprosium. For listeners who hear rare earths as just a buzzword, why is that specific element so important?
It's a heavy rare earth, which is critical for the high-performance permanent magnets you find in, EV motors, wind turbines, and advanced defense systems. It's what allows those magnets to work efficiently at very high temperatures.
And hitting that 99.9% purity is what opens the door to commercial buyers.
It is the absolute key. It's the commercial standard. But the real validation, the proof, is that their product has already been qualified by a major South Korean auto manufacturer.
Wow. Okay. So that's not just a lab success. That's commercial validation.
It is. It proves their process works in a real-world, rigorous setting. And it immediately opens up this crucial, high-value revenue stream that is not dependent on China.
And that's the big geopolitical angle here, isn't it? This creates a domestic U.S. supply chain for something China currently dominates.
Absolutely. From a geopolitical standpoint, this asset becomes strategic overnight. Western manufacturers are desperate to de-risk their supply chains, and this gives them an option, a very real option, that they haven't had before.
So what's next for the rare earth segment? What's the next milestone we should be watching for?
The focus now shifts to scaling up. They're expecting to deliver qualification samples for terbium oxide, that's another critical heavy REE, in early 2026.
Terbium, okay.
And the big goal, the really ambitious part, is to have commercial scale production of both dysprosium and terbium fully ramped up by the fourth quarter of 2026.
Q4 2026, that feels like the single most important date for this entire story. But executing this kind of growth, I mean, building out rare earth capacity and developing a whole other project in Australia, that takes a ton of cash.
It does. And that's where their financial strategy has been very smart. They recently secured a $700 million convertible senior note offering.
700 million.
Yeah, and that, combined with their existing cash, boosted their working capital to nearly $1 billion. They've effectively eliminated any short-term financing risk.
A convertible note of that size is significant, but I wanted to dig into the structure of it, specifically these capped call transactions. For our listeners, why is setting the conversion price up at $30.70 so important?
It's a fantastic question, and it's critical to understanding the institutional confidence here. Normally, a convertible note can dilute existing shareholders if the stock price rises and the debt converts into new shares.
Right, more shares flood the market, your piece of the pie gets smaller.
Exactly. But with a capped call transaction, the company basically buys an insurance policy. It effectively raises the price at which that dilution would start to happen. In this case, all the way up to $30.70 a share.
So it minimizes that immediate risk, and it also signals that the institutions buying this debt believe the stock has significant upside.
A huge signal of confidence. They're betting the stock will climb substantially before that conversion even becomes a real issue. And they locked in that capital at a tiny 0.75% coupon. It's very cheap money.
So we've got the unique asset, the technical breakthrough, the uranium profits, and now a $1 billion war chest. It's a strong bull case. But let's talk about the other side. What are the biggest risks here?
There are two main risks, and they're tied together: valuation and current profitability.
Let's start with profitability, because the numbers, they don't look great right now.
They don't. The company is currently loss-making. Forecasts for 2025 EBITDA margins are deeply negative, around minus 94%, with an expected EPS loss of about 33 cents a share.
And critics would point to that and say they're just burning cash.
They would. But the counterargument is that this isn't operational weakness. It's the cost of building out this massive platform. They're in an investment phase.
So they're framing themselves as more of an early-stage growth company.
That's the argument.
Yeah.
But it leads you directly to the biggest risk of all, which is execution risk.
Meaning, can they actually pull all this off?
Exactly. The entire investment thesis, everything we've talked about, hinges on management executing this multi-project ramp-up on time and on budget. Any significant delay, any technical problem scaling up at White Mesa, it could severely damage the stock because the market is already pricing in a lot of that future success.
Which brings us to valuation. Skeptics point to a price-to-sales multiple of, what, around 47x? That's steep.
It is very high, and that's a valid concern. The argument is that too much of that future growth is already reflected in today's price.
The future is already baked in.
To some extent. Now, what mitigates that a little bit is that the stock has already had a pretty big correction from its 52-week high of over $27. So some of that froth has come out.
So despite these risks, what's the general feeling in the market? And more importantly, what are the key catalysts we should be watching for in the next few months?
Well, the overall analyst consensus is still a strong buy. And institutional ownership is high, around 48%. It seems like the smart money is holding on through the volatility.
And the near-term catalysts, the checkpoints for investors.
There are a few key things in the next quarter or so. First, the Q4 2025 earnings release. That's our first real look at uranium sales volumes and an update on the REE timeline.
Plus,
Then you've got institutional flow. ETF rebalancing in December can move the needle, and then the 13F filings in Jan and Feb will show us if big funds were buying during this recent dip.
and the most important operational one.
That would be the update on the terbium oxide qualification samples. That's expected in early 2026. Hitting that milestone will be another major de-risking event.
And hovering over all of this is the long-term macro tailwind.
Without a doubt. Continued U.S. government support for domestic critical minerals and nuclear power is a powerful ongoing catalyst. Washington sees this as a strategic imperative.
So when you put it all together for the long-term investor, what's the takeaway? It really seems like a fascinating risk-reward profile.
It is. You have this unique mix of geopolitical importance, a validated technical breakthrough, and a very strong capital position, all backstopped by those high uranium prices.
But the market volatility is pricing in that execution risk you mentioned.
Exactly. If they hit that Q4 2026 production target, the growth potential is just enormous. You can see it in the analyst price targets, which are all over the place. The conservative end is around $16 but some bulls see it going back to nearly $27.
That's a huge range. It really shows how much hangs on them executing this plan.
It does. And the question you have to ask yourself is, are you buying an early-stage growth story with massive potential, or is the market already priced for perfection?
That's a great thought to end on. Thank you for helping us unpack this complex story. Don't forget to subscribe, like, and comment to support the show, and let us know what company you want us to look into next.